On Wednesday, the Federal Reserve hiked rates another 0.75%. This tough-on-inflation move is the steepest rate adjustment since '94. Here's what to expect next. Until the Fed sees inflation receding, it will probably raise rates at least 0.5% every meeting from now through the end of 2023. These rate adjustments may help curb demand, but they are not going to directly lower housing prices. Only more supply can do that. Expect home prices to continue increasing, but at a slower pace than last year, and rental rates to continue their fastest rise throughout 2022. According to Jerome Powell, Fed chair said that the supply of finished homes, the inventory of finished homes that are for sale, is historically low, so it's still a very tight market. So prices may keep going up for a while, even in a world where rates are up. According to Daniel Hale, Realtor.com chief economist, with mortgage rates and other long-term interest rates surging before the Fed meeting, we may somewhat paradoxically see rates ease somewhat in the days following the Fed's hike. For the first time, May saw year-over-year increase in the number of active listings available to buyers at any given time. Inventory is back on the rise. The turnaround is only in its infancy, and inventory remains near historic lows for this time of the year and is expected to continue heavily favor sellers for the foreseeable future. According to Matthew Gardner, chief economist at Windermere, he is not expecting the future increase in rates pushing the mortgage rates even higher. In fact, the Fed's move on Wednesday was anticipated, and the market made proactive adjustments that sent mortgage rates surging above 6% before the meeting. And because there's not a direct connection between federal fund rate and long-term interest rate, multiple economists suggested mortgage rates could take a slight dip on Wednesday's news in a temporarily bright spot for agents wary of shifting market. We will not see home foreclosures because, looking back at the total inventory data going back to 1982, the only panic selling we saw was forced credit stress selling. The homeowners now don't have exotic loan debt structures they need to recast, and their cash flow is good. To sum it all up, housing inventory is low, prices will keep rising, but not at the pace of 2021. Sellers and buyers need to understand the market is shifting and inventory is starting to increase. Supply is not satisfying the demand. There will not be a market crash we have experienced in the past. Homeowners have equity in their homes and will not be panicked into selling. In the light of recent rate hikes, there is a light at the end of the tunnel that mortgage rates might take a slight dip temporarily. But compared to 1982 interest rates, they are still low. Call me if you need help with your real estate. I can help you navigate this shifting market. Thank you. Bye.